All right, let's get straight to it. This is a critical market briefing for the week ending December 14th, 2025. You really need to pay attention because the market just sent a signal you absolutely cannot afford to ignore. We're going to break down exactly what that means for your portfolio as we head into the new year. Okay, before we dig into the data, here's the mandatory disclaimer. This is a strategic briefing. It's for educational purposes only. It is not financial advice. Every investment decision carries significant risk. Now, let's get to work. So here it is. This is the central paradox that completely defined the week. The Federal Reserve delivered a rate cut, which is textbook rocket fuel for stocks, and the market absolutely tanked. Look, if you don't understand why that happened, you are flying blind right now. The answer is everything. What we just saw was a classic sell the news event, but it had a really venomous twist. Amateurs looked at this and they saw profit-taking. Professionals, well, we saw a fundamental, violent repricing of risk across the entire board. Let's dissect the mechanics of what we're calling this hawkish cut. Here are the facts. On Wednesday, the Fed cut the federal funds rate by 25 basis points. That puts it in a range of 3.5% to 3.75%. In any normal environment, that is a green light for risk assets. The thing is, we are not in a normal environment, not even close. And this was the market's verdict. The S&P 500 dropped 1.1%, and it was led by a complete bloodbath in the exact same growth stocks that were supposed to rally. When you see a divergence like this, a rate cut met with heavy selling, that's not just noise. It is a blaring signal. The market is listening to a different story. And this is the term you need to burn into your brain: a hawkish cut. See, the market completely ignored the action, and it focused on the message. The Fed gave everyone a 25 basis point cut today, sure, but in the same breath, they signaled they're taking away the punch bowl for tomorrow. They effectively promised pain later. And here's the justification, straight from Chair Powell himself. He pointed to stubbornness in inflation, which is now taking back up to 2.5%. That's not just a data point, it's an admission. He was signaling to the market that the inflation fight isn't over, and frankly, that the Fed is losing control. They are behind the curve. And this right here, this is the divergence that blows up portfolios. The market was priced for a complete fantasy: 4 rate cuts in 2026. The Fed just came out and told you to expect 2. That gap between market hope and Fed reality, well, it's a chasm, and capital is falling into it as we speak. So this divergence, it triggered the next phase, the Great Rotation. The smart money heard the Fed's warning loud and clear, and it started moving fast. If you want to know where the market is really headed, you follow the capital. We are witnessing a violent rotation out of speculative tech and into tangible assets. The capital that was chasing these AI supercycle narratives is now in a dead sprint to safety. It's moving out of promises and into things you can actually hold: gold, commodities, and, very importantly, Bitcoin, which is finally beginning to trade like a hard asset, not like a tech stock. I mean, just look at this price. Gold smashing through $4,000 an ounce isn't just a rally, it's a vote of no confidence. This is institutional capital buying insurance against a major Fed policy error. The message from the gold market is crystal clear: the Fed is trapped. And this is the single most important theme for 2026. It's called the devaluation trade. It's a simple and brutal calculus. It's about protecting your purchasing power, as central banks are forced to sacrifice the currency to save the economy. Now look at Bitcoin. It's holding this absolutely critical $92,000 support level. While high beta tech was getting liquidated, Bitcoin didn't even flinch. It's behaving like digital gold, not a risky tech play. That relative strength is an incredibly powerful signal about where capital wants to be. So what's the endgame here? Where does this all lead? The Fed, in its attempt to appear tough on inflation, has sprung a trap on the economy. They are actively engineering a stagflationary outcome for 2026. And you don't have to take my word for it. These are the Fed's own projections. They are telling you right here that growth is slowing, unemployment is rising, and inflation is remaining sticky. Slower growth plus persistent inflation. That is the literal definition of stagflation. This is the scenario the market is now calling stagflation light. And let me tell you, it's the worst possible environment for traditional stock portfolios. And it's exactly the outcome that the bond and gold markets have been screaming about for months. So let me be very clear. The easy money has been made. The period of just buying the dip in tech and riding these massive liquidity waves, it's over. From this point forward, risk management is paramount. Your entire focus must shift from offense to defense. So, how do we position for this new regime? What do you actually do? Here is a simple, strategic playbook for navigating the first quarter of 2026. First, you reduce beta. That means cutting exposure to your most volatile, high-growth stocks. Second, get long volatility. The VIX, the market's fear gauge, is waking up from a long nap. Third, and this is the most critical, you need to own hard assets. The gold chart is the only one that really matters right now. And finally, watch Bitcoin. It must hold that $92,000 level. A decisive break above $94,250 would be your signal for the next major leg up. You know, it all comes down to the oldest rule in the book. Don't fight the tape. The market is screaming at you that the game has changed. Your job isn't to hope it's wrong. Your job is to listen and adapt. So I'll leave you with this one question to think about over the weekend. In a world of slowing growth and sticky inflation, this stagflation-light environment we've just discussed, where is the last truly safe haven for capital? The answer to that question will likely define your entire portfolio's performance in 2026. And remember, this briefing was for educational and informational purposes only. You should always consult with a qualified financial advisor before making any investment decisions. Stay vigilant out there,